Hello, good morning everybody. Thank you for coming to our webinar today, the what, when and why of self-assessment. So obviously self-assessment season is soon to be upon us, so I thought it'd be a good idea to get some information out there, some tips and tricks with Lucinda. So let's kick off. Right, here we go. So my name's Ben. I'm the sales team manager here at Crunch Accounting. I'm joined by Lucinda, who's deputy head of accounting here at Crunch. So thank you for coming, Lucinda. She'll be able to answer all of our questions and give us some insight into self-assessment. Thanks.
You're welcome.
So in today's webinar, there's going to be a whole load of content about what you need to put into your self-assessment, when you need to file for self-assessment, all those types of overarching information that apply to everybody. But then at the end, we're going to have a Q&A section as well, where we can answer all of your questions. So get your questions into the GoToWebinar little pop-up window. Get them in at any time. We'll come back to them at the end and answer them all, hopefully for you live. We've got some recommended reading for you as well. So there's a handout in the GoToWebinar pop-out too, which you can take away links to all of our recommended reading on our website. We've got a really rich blog and white paper resource on there. So feel free to go download those through the GoToWebinar app and you can read them at your leisure as well. Now, for those of you that may not be Crunch members or thinking of joining Crunch, a little bit about us is that we're an accountancy firm at the heart of what we do. We've got over 10,000 paying clients, satisfied clients with us at the moment, but alongside that we also do all sorts of other different services for those people that may be self-employed, such as mortgages, insurance, advice on pensions and investments, and everyone that is a Crunch Accounting client or customer has their own dedicated resource in the office too to provide support and help when they need it. So let's kick into the actual meat of the webinar. So who exactly needs to complete a self-assessment, Lucinda? Does everyone have to do it? Do some people have to do it? What's the go?
Absolutely. Not everyone needs to have to complete a self-assessment. I guess that's the key thing. We just need to establish that first. The common are sole traders. So this is you running your own business as an individual, operating your own trade. It could be something in web design, something like that. And it's you as an individual running your own business. Another option, another potential may be a company director. So you have a limited company and you're appointed as a company director at a company's house. The likelihood is that you will potentially need to do a self-assessment. And then really anyone who receives income that isn't taxed at source. So if you're employed and you receive a pay slip every month, the likelihood is you're not going to. But if you're receiving income that isn't taxed at source, you should need to look into this. Now, the UK government website has a great tool that you can complete online. It's very straightforward, and that will help you to establish whether you need to file a self-assessment.
Great, we can link you to that as well. So I suppose once you've established whether you need to file a self-assessment, the next thing is, okay, well, what do I need to do now? I need to register for a self-assessment, right? So HMRC can expect that in the post. So when do you have to do it, first of all? When does it need to be done by?
Absolutely. So the UK tax year runs from the 6th of April to the 5th of April the following year. The set dates don't change. You need to register by October the 5th following the end of the tax year that you have identified that you need to do a self-assessment. So if you started trading as a sole trader and you're self-employed and you were trading in the 17-18 tax year, then you'll need to have registered by the 5th of October. I understand that's passed and we're gonna come onto that slide next.
Okay, so what happens if we have missed that date of the 5th of October?
Absolutely. But please don't worry. You know, these things happen. The main thing is now you need to get your registration done. You could face a penalty, but this is where we're going to come and help you out and give you a couple of tips here, because actually once you get registered and submit your self-assessment, by the 31st of January 2019 for the 17-18 tax year. These penalties could be reduced or potentially even removed entirely. You may need to speak to an advisor to get additional advice and support on that. But please don't panic. The main thing is now get yourself registered if you feel you should have been, and get yourself organised and start looking into getting your self-assessment submitted.
Okay, so take some action.
Definitely.
Okay, right.
Take some action now.
So now we've registered, hopefully before the 5th of October, the following tax year. But what will I get when I actually register? What happens next? What are the bits that come?
Yes, each individual will receive a unique taxpayer reference number, often referred to as a UTR. It's unique to you, obviously, by definition of its title. You need to keep this safe and secure. You're going to use it with all of your correspondence with HMRC, all of your filings. It's going to be on any letter that you receive from them. So keep it safe. It helps you communicate with HMRC about any of your personal tax affairs. If you've registered before, though, if you maybe were a sole trader a few years ago and then maybe went back into employment and you were registered before, you won't get a new UTR. You can just re-register. So you just need to locate that from any old correspondence and get re-registered.
Okay, so UTR sticks with you for life.
Sticks with you for life.
Okay, cool. I think this kind of is answered by you, but do you have to register again every year?
No, that's the key thing. Yeah, once you're registered, you're expected to then complete a self-assessment every year. HMRC won't expect a re-registration. They'll just expect you to submit your self-assessment. Key thing is, if you don't think you need to complete a self-assessment, again, get in contact with your advisor or HMRC, because then you might need to just put that on pause if you've gone back into employment again. It's really key that you keep them informed, because if you don't tell HMRC, they'll just expect it. So keeping them up to date with your affairs and your status will ensure that your registration is in its right position.
Great. So we've got a really good blog article on our website called 7 Reasons Why You Should File Your Self-Assessment Early. Again, we're going to link you off to that in that handout that's in the GoToWebinar pop-out. So feel free to grab that so you can take it at any point too. Now, we need to think about how we're going to keep our records, right? So some people keep it old school paper. What's the best kind of way for that to be done?
Absolutely. I mean, record keeping for us is key. Of anyone who needs to complete a self-assessment, it certainly helps the individual who's preparing it themselves, or if they're going through with an advisor to do it. You don't need to keep paper records. Yeah, absolutely. It's not, essential that it's always paper records. You can keep electronic records now. That's perfectly acceptable. Either you or maybe your advisor, if you're working with them, are going to need to see that. And potentially, if HMRC ask in the future, they might need to see that record. So spreadsheets are a great way. Obviously, we have an online accounting system that helps our clients. So getting involved with an advisor who has a system that you can log into and keep a record of all your income and receipts just makes everything so much easier. Saves you a lot of time, saves you a lot of stress, and it means that you can just keep yourself organized, and when that year ends, you're pretty much good to go. Great.
So the good thing about those kind of electronic records is it means you can do it kind of as and when, isn't it? Rather than having to do this big piece of work at the year end, you can manage it as the year kind of passes you by. So what type of things, or what type of income, what kind of business income needs to go into the self-assessment?
Right. Yeah, I'm going to split this down because everyone's got probably some different circumstances. So I'm going to put this relevant to maybe whether you're a sole trade or maybe if you're a director of a limited company, just to give it some clarification. Now, either one of those, you might have had some income from employment. This is salary. This is where we're talking about you've had a pay slip through, whether it's weekly or monthly, from an employer. That could have also been your limited company. So this is crucial that this is why we mentioned this. This type of income could cover both. Now, what you'll need to be looking for to make a record of salary on your self-assessment is your P60. You should receive a P60 from your employer at the end of each tax year. So keep that safe, locate that if that's for 17-18. It summarises your income and tax paid on that income. So it's really then quite simple and useful then to make a record. So that's a key piece of information. Another type of income from employment that you may have received from your employer, again, also applies if you have a limited company, is a P11D. Now, a P11D is income which is a taxable benefit. So classic examples are private medical insurance, or maybe a company car. All of these are deemed income. They just receive it by another means, i.e. the car, and being able to use that. So again, keep that handy. If you've got that, locate it, get it ready to do your self-assessment. Now, finally, you may have left an employment during a tax year. And so the form you need to look out for is the P45. P45 gives you your end of earnings when you leave that employment. And again, it summarizes nice and simply what income and what tax is paid on that.
Great. So now we're thinking about kind of sole trader income, your self-employment income, right?
Yes. Yeah. So this is you as an individual running maybe your web design business. The simple way to keep this is simply keep one set of data for your income. So this is all of your money that you've received from your clients, your customers, and you'll need to keep a second set of data, which is all of your expenses. This is everything that relates to that self-employment income. So every expense that related to you providing that service. Income, less expenses, simply gives then your profit, hopefully, for your self-employment. Great.
So if you're a limited company, you're going to be extracting dividends out of your business. So they need to go on there too?
Absolutely, absolutely. We have many clients at our company at Crunch that are limited companies, so they're directors. They have their salary, but mostly they also receive dividends from their limited company. Dividends are obviously not salary, so you don't work in the same way. You don't really have a pay slip or anything to identify that. You'll have some dividend vouchers. Dividend vouchers are your key piece of information to make a record of your dividend income. If you're using an electronic system, potentially they're already stored there and you can take your records from there. Again, can be paper as well, so don't necessarily need to be online, but obviously it's much simpler.
Okay, so they're the kind of three key bits of income that people generally tend to have, right?
Absolutely,
Salary,
yeah,
dividends,
big income.
Sole trader, but there's all sorts of other things that might be there as well. Do you want to talk us through some of the bits there?
I will do. So these are a mix. So this type of other income, you don't necessarily need to be one or the other. It could be a bit of both. It could be something you just have on the side. So I'll go through these fairly briefly, just to give you an idea of the other income. You may be involved in a partnership as well. So if you've set up a partnership with another partner, again, it could be within a business, you might have obviously received some partnership drawings out of that relationship and that business, and therefore you'll need to record that income. It's very similar to the way how you account for your business income with your income less expenses. So you'll need to keep a record if you're involved in that, and you'll probably take that from potentially partnership accounts. So keep a record if you have those. Some of us do have some savings, and if we're receiving any interest from banks or building societies, then again, you need to make a record of that, just so that we know that the interest has been received, and then if there's any tax due on that interest. So keep any statement that you receive from a bank or building society at the end of the tax year. They normally issue them sort of late April, and they're usually quite obvious. They'll say it's like a tax statement or an interest statement. So they're really handy to prepare your tax return, your self-assessment quite easily. Some people might have a rental property, maybe something you own by yourself or potentially with someone else. Either situation, again, you'll need to record the rental property profits from that adventure. Again, simply, you'll need to know what income, so what rental income you received from that property and all of the expenses associated with it. There are some expenses that may not also be allowable. So again, if you've got this situation, strongly advise, speak to an advisor just to make sure that you're making the right records there. Also, we might have some interest from overseas, or dividends from overseas, or any other overseas income. Again, keep these handy, because as UK taxpayers, you're likely to have to make a record of these. Potentially, even if the tax is paid overseas, then you might get some relief there. But keeping all of that information in one place will make it easy.
Great, you got some more here?
I do, yes.
Continues.
Some of us, we might also already be receiving some pension income. And again, now pension income is most likely to have been driven from previous employment. So again, this one's quite simple, because you'll need hopefully your form P60, which will be very similar to an employment income form, and that will just give you the details of the pension income you received. If you've had any assets sold in the year, you potentially might have a capital gain, and there may be some taxes due on that. Now, what's an asset? This could be a second property, it could be shares in the UK, shares overseas. So just being aware of that might also give rise to capital gains, which is a type of income that could be then subject to some taxes. Finally, these aren't necessarily incomes that you might typically see, but there is a type of income for self-assessment. So if you've received a student loan, if you've been studying in the past, you'll need to inform HMRC, because the repayments of the student loan will go through your self-assessment. Okay, bit tricky, because you might have also made some repayments potentially through employment. That's absolutely fine. There'll be a record of that within a P45 or P60. But if not, this is your record to tell HMRC. And then finally, if you're receiving child benefit, you may need to make a record for child benefit for your household. There is some limitations on that one, and it depends on the household's income. So again, I would advise just making sure you speak to an advisor if you're receiving child benefit.
Great. So I think now you've got some reminders on tax relief, so ways to drive down your tax bill. Is that right?
Yeah, that's right. I think, again, these ones sometimes get forgotten as well. People aren't always aware about how it works, especially if you're a sole trader, self-employed. So a lot of us now are making savings for the future, pension contributions, and we're doing these personally, privately, ourselves. So keep a record of these pension contributions that you're making in the year. They're really key to ensure that anything that you're paying out through the year is made a record of on your self-assessment, as it may give you some relief. You should be able to get all of these details from your pension advisor. So keep a record of those, and again, you should be able to get them so they align within that UK tax year as well. Okay. And also charity donations. A lot of us now making, again, donations to charity would be able to claim diff relief on this if you're a UK taxpayer. So again, details would be, it's ideal to keep ready for your self-assessment, again, because you do get a little bit of relief from that. So obviously a nice way to say thank you back for making those donations.
Great. So final kind of tips and trips checklist, I suppose, is that?
Yeah, keep a record. That's got to be the key one from me from today. I think it will just make everything a lot smoother. You won't feel like you're having to do this whole big exercise and go back through 12 months worth of records. And also potentially, if you're doing it, later on, it can feel like some of this income came in 2 years ago, and it will feel really sort of old, and you've probably moved on to new and exciting projects. So keep a record. It makes it really simple. The records to keep, I think electronically is obviously, it's an easier one. It certainly speeds up the process. It helps you keep everything in one place. Everything's date recorded, usually everything's backed up, everything's nice and secure. But obviously paper sometimes is necessary as well. I guess this is the big one, isn't it? How to pay the tax. That's what everyone wants to know. Obviously, the liability that is due to be paid for your self-assessment is always due to be paid in full by the 31st of January after the tax year end. So if you're looking at the 17-18 tax year, it's due to be paid in full by the 31st of January 2019. Okay. And finally, this is an idea that not many people will be aware of, but payment on accounts. So the way the system works with HMRC in the UK is if your tax liability is more than £1,000, you'll need to make a payment on account. And these payment accounts are paid alongside normally your first bill, so the 31st of January 2019, and they are 50% of the estimated for the next tax year. And if obviously your income's about the same, then it's usually 50% of your current tax bill. And then they're paid in the January, and then in the July. So then the next one would be due in the July 2019, be 50% obviously towards then the 18-19 tax year. The benefits of doing payment account, obviously you're paying your tax liability sort of through the tax year. So hopefully then come the end of it, it's pretty much paid in full, unless there was obviously an unknown source of income that you weren't aware of or you weren't expecting. But it just helps then from a personal point of view, just being organised for your cash flow, no surprise tax bills. It kind of puts people back in line if they've ever been in employment as well. They've sort of taken responsibilities throughout the year, and then it puts you in that place where you're kind of up to date as well with your liabilities.
Perfect. So if in doubt, speak to a specialist. I suppose that's where you come in, isn't it?
That's it. And I'm hoping we're going to have some questions because this is, it's something we've been doing here for obviously a number of years, and myself as well, and really passionate to make sure that people feel comfortable about it. It doesn't need to be complex. We don't want anyone to feel, sort of overwhelmed by these situations.
Great. So a good place for anyone that may be on this webinar to find some additional reading is Crunch Chorus. It's a free community that we have here at Crunch, where we've got access to webinars like this one, free business guides, some free invoicing software for sole traders, document templates, meetups, all sorts of different things. So definitely go and look at that, sign up. It doesn't cost you anything, and it's a good place to get some more information like this. crunch.co.uk/chorus. Now let's do some questions and answers. So hopefully we have got some good questions that have come in. So right, let's have a quick look. I became self-employed in October 2017. Would my tax period be for then until April?
Yes, that's right. So from October 17 right the way through till the 5th of April 2018.
Okay, great. Got one here. How are you able to determine what is an allowable expense on rental income? Historically, interest on a mortgage is unacceptable, but understand this may have now changed.
So to know what an allowable expense would be, is it really needs to be wholly, exclusively and necessary for the purpose of the trade. Interest on mortgages is still an allowable expense, but there may be some situations that are quite unique, possibly to the property. If it's a buy-to-let, we might need to look at that situation in a little bit more detail to make sure you get the right answer on that one, because some of the interest then might not always be allowed.
Okay, so speak to
a professional advisor. Yeah.
Okay, so you say you may need to record child benefit. What would make me need to record this? Are there specific criteria?
Yes, if the household has the household's receiving the child benefit and the individual's income is more than 50,000, then they'll need to make a record of the child benefit that they received.
Okay, great. Here, how do you get a UTR number? I think that's just kind of at the start. So is that right?
Yeah, that's it. So potentially just obviously double check and make sure you haven't already registered for self-assessment. If you've got one, you should have received it from HMRC. It'd be on all correspondence. However, if you haven't ever received one, you don't feel you've got one, get registered and then HMRC will issue it to you.
Okay, great. We've got this one. Can I use my tax return for things like letting or mortgage references? And if so, what sort of information would be presented on it and on it that would assist me with securing something like these?
Yeah, absolutely. Quite often directors can use their personal tax returns. Sole traders can use their personal tax returns as well for that kind of lending. It's a great tool to give an overview for the individual for the year. What I would say though, it is worth double checking with your broker, your agent, your bank as to what information they require. Sometimes they may need a little bit more in additional to the self-assessment, and if you're working with an accountant, they would also be able to help out usually in that situation.
Great. Does Crunch offer a service that is for personal tax without being a Crunch subscriber?
Unfortunately, not at this stage. It's something that we would be looking to do in the future, but at the moment, we're not able to offer the self-assessment service as a standalone.
But we'll definitely let anyone. We'll definitely be letting people know that we will be having that service when that does come to fruition.
Absolutely.
What should I do if I'm unable to pay the amount I owe HMRC? If there's something that you could help me with.
Yeah, I think if you're not sure about how you're going to make a payment, the best thing to do is speak to HMRC. Please don't be afraid of them. The right thing to do is to talk to them about your situation. Tell them what the liability is, explain what you're able to maybe pay, and then you can work with them on if they might be able to offer some sort of payment plan. They often come with interest, but at least you're not ignoring the tax that's due and just allowing it to potentially rack up as debt. So I would strongly advise just speak to HMRC if you're unsure about what you need to pay and when, and if you can pay it.
Okay, so here is a question about last year's tax return. So last year I had someone else produce my tax return and they got the whole thing wrong, which cost me hundreds in additional tax. What sort of precautions does Crunch take when handling this kind of sensitive information to ensure it's done correctly?
Yeah, absolutely. So we obviously collect all the data from the client, so all their income, all their potential relief. So we get sight of that and then we prepare a draft self-assessment. That is really important for us because that draft self-assessment goes to our client first to review. They'll have questions and we welcome that. We want the client to understand what the tax return is saying. And then we ask for approval from the client before we file. So we won't be filing without approval.
Okay, that's
good. The client's approval, yeah.
We've got one here about someone that's recently moved to the UK. So I've been self-employed elsewhere in the EU and now I'm moving to the UK. How do I handle tax during the transition? It's more or less 50-50 abroad and in the UK.
Oh, that's good. That's good. Yeah, great question. So what you'll need to do is you'll need to establish your UK tax residency. It happens very, very frequently where people move in and out of the UK and it's in between a tax year or in the same tax year. So again, on HMRC's website, they have a tool for tax residency. So it's the key thing. If you search for that, you'll be taken to a questionnaire. There are a number of questions. There are probably about 14 in total, I think, last check. So be prepared. You need a bit of time to sit down and go through it. But quite simply, when you do go through that, at the end of the questionnaire, it should be able to tell you and establish for you what your tax residency is. And then you'll know whether you should need to complete a UK self-assessment.
Perfect. So I think that pretty much wraps us up. It's like bang on half an hour now, so that's about perfect. Thank you very much for everyone that joined. Thank you, Lucinda.
Thank you, everyone.
And join us again next time. Thank you, everyone.